Are market conditions favorable to your circumstances? Stay tuned. Welcome to this week's edition of NoteSchool TV. And well, this is our monthly update. And we have a lot of information for you today as to what's going on in the world out there. So we're going to jump right into that very quickly. Before we do, just a few housekeeping items. Please make sure and like this episode. Yep, go ahead and hit the like button. Share this with your friends and your business colleagues and everyone out there, right? We'd love for you to do that. It always helps us out here at NoteSchool. And number two, make sure and subscribe to the NoteSchool TV channel if you have not already done so. And lastly, hit that bell notification. Yep, go ahead and hit it bing so that you will be notified every Wednesday at 11:05 that NoteSchool TV is going live. Also, make sure and continue to send us your questions and your comments. We love to hear from you. We love to hear what you have to say about your market and what's going on in your business. With that, I want to bring on our Chief Visionary Officer, founder of NoteSchool, my friend, Mr. Eddie Speed.
Good morning, Joe.
Good morning, Ed. It is a good morning.
It is a good morning.
Yeah.
And we call that kind of right? Like the market is changing and it depends on where you sit.
Yes.
As to finding opportunity with that or finding a place that you need to readjust. This is why we do the market update once a month, is to bring an awareness of kind of the weather report of the market so that if you need to make an adjustment, we may not tell you everything you need to know to make an adjustment, but we're going to tell you, we're going to point to the weather report and we're going to say, this is what the market is saying. Is it time for you to consider an adjustment, or are you just absolutely in the right spot?
Absolutely.
Right?
Yeah.
Let's hit it.
Let's hit it. So here we go. Eddie, talk to us about this just a second.
You know, it's just a truth. It's better to do the right thing at the perfect time than do the perfect thing in the wrong time.
Yeah.
And we've seen a lot of market conditions that have drastically shifted. Our friends in the rental property space, our friends in the multifamily space. Yeah. Like while they had the hot hand and things were going their way, we've seen a big shift. And this is what kind of caused this. And that actually was a quote that I did on a podcast that somebody then made a thing out of, right? So it was a podcast interview where I talked about where the market was going a month or so ago. And probably relevant to what we're saying today here, Joe.
Yeah, I think it is. Let's jump right into it. So the different cycles, right? They bring us different opportunities. And Eddie, as we circle the house there, thoughts on that?
You know what? 4.5 decades. Not everything stays the same. In fact, virtually nothing stays the same. They say the only thing constant is change.
Yeah.
And so we are seeing a market shift, and I think there is terrific opportunities with it, but there's opportunities if you know it's shifting.
Right.
If you don't know it's shifting, then that's a little bit like walking out in traffic with a blindfold on. You might not really knew there was a car coming, but anyway, that
a little closer than we thought, right?
So we're gonna continue to drive this point because in 4.5 decades, Joe's, this is what I've learned.
Absolutely.
Like this truth is the biggest truth I've ever known and experienced in the business. Let's rock it.
Let's rock it. All right, let's talk about the housing market. So, Eddie, let's see. Home listings are up in more than 60% in some cities. So we've got 60%. And nationwide, according to Realtor.com, in August, 36% compared with the same time last year.
Yeah, we saw it. We did a chart that was back in June. We've got another one that's updated for August because, some of those numbers have tweaked a little bit. Some of them are down and some of them are up. And Florida is the one that's jumping off the page. And let's just look at that, Joe. Let's let's see that chart, and let's talk first of all about listings right there. That is from Fred, right? The Federal Reserve.
Yep, Federal Reserve. And in August, yeah, well, you can see listings are right here. They've gone up to just under 1 million.
So
and
if you look at that trend
909.
line, look at that trend line this year, and you can just highlight that trend line up, Joe, and it's just continued to, you know, that's what we're watching. Like, you know, I'm not saying there's not other trend lines, there's not other things, but we are watching this because we're now approaching an inventory level that we had in 2020. So go back to 2020 and kind of draw across, and you can kind of see, you know, right there where that shaded spot is in the middle, there you go, and just you can kind of see we are approaching the same inventory level we had before the virus started, right? And so we've been way below it. That's been a big topic of conversation. We're not up to normal yet, but there are some things that are causing some abnormal behavior, at least what's happened in the last 4 years.
Okay? Right. All right. Yeah, so here is the updated chart again. I think in Florida back in June, with first one of these we had found was at 71%. So it's ticked down a little bit, and everybody on there, you know, it's about the same. It's not, you know, we still have, of course, you know, here. And so, yeah.
So one areas that we're looking at, Texas is down a little bit.
Yep.
But the other states that have been really hot, Colorado, Arizona, you know, California, Georgia, the Carolinas, all of those markets are right at that 50% increase in listings. So understand, we're watching this. That doesn't mean everybody's headed for heck, but it does mean there's a lot more properties on the market. And I can tell you from experience, overpriced market properties are not selling. I hear this from every real estate investor I'm around. I just got back from my friends at Collective Genius last week. And, you know, I go to these masterminds and I pay attention to what these top house buyers are saying. If it's overpriced, it's not selling.
Yeah. Days on market for those has increased to about 53 days, Eddie. So yeah. All right. Let's look at they're seeing huge gains. Look at Tampa. Tampa is at 90%. San Diego is at 80%. 72% in Miami, 69% in Seattle, and Denver is up 67%. And here's that 53 days that I was talking about.
Gains in inventory. How many properties are listed on the market? So we kind of knew this was likely to happen. And actually what, you know, people are pretty amped up about rates. And I get that mortgage rates seem to be sliding down. But it also increased the inventory of houses on the market.
Absolutely. Absolutely. And one of the phenomenons here in Florida, Eddie, is the condo situation. That's another episode, but yeah, absolutely.
You mean a dumpster fire?
That's what I mean. Yeah, you
haven't heard there's an issue with condos in Florida. You might want to do your research before you dive into that next deal.
Yeah, please. Just err with caution on that, right? Just
doesn't mean there's not any deals, but it means that you better be fully aware. Don't listen to the promoters always, right?
No, that's right. All right, so Eddie, here's 10 markets that Realtor.com says that will plummet by the end of 2024, and you know, we got San Francisco all the way down through Washington, D.C., and some kind of outliers here is St. Louis and Chicago.
I would say St. Louis and Chicago. I agree. The rest of them have been really hot. They've been too hot. We knew they had to cool off.
Yep.
Not a shocker. But those are markets that kind of surprised me a little bit because those are more blue collar markets, and you see the average price of properties on those are way below what the rest of them are. So
for sure.
Not a shocker, but we've said this. We've alluded this in the last few of these market updates, this month-end reports, that we are watching it and we are continuing to do it. Have a little bit. It's forming a little more that Joe now than when we first brought it up, right?
It is. It's starting to develop. That's right. Yeah. Yes. All right. Let's talk about banks, Eddie.
Good news for our friends. Mortgage rates are going down.
Look at that. Look at that.
Yeah, the arm thing. I don't even know why they would quote an arm. I mean,
No
like,
rhyme or
I have
reason.
no idea.
Yeah.
But anyway, mortgage rates are going down. And this, if you monitor it, it's about 1% or 100 basis points, as we say in our industry.
Mm-hmm.
It's about 1% less than it was, earlier this year.
Yep.
And so, yeah. And we're glad to hear that.
We're glad to hear it. Yeah, absolutely. Yeah. Now, mortgage credit availability index has finally ticked up a little bit, Eddie. Last, that would have been in August. It would have been at 95. And this is the first time it's really started. Well, you can see the line there over the last little bit, but it's made some movement now. But still.
This is why people are seller financing. Yeah. They're seller financing not because of rates. They're seller financing because of mortgage underwriting. Yeah. And mortgage underwriting is still twice as half the people could qualify that could qualify before the virus. That's the reason people are seller financing.
Absolutely.
So people say, are mortgage rates going to dip deep into people's seller financing? And I say, absolutely not.
No. It's just availability of credit.
Quite a bit. And I think as real estate, there's more real estate available and there's more real estate getting sold, maybe longer on the market, but it's still getting sold. I think we're going to see a big increase in seller financing. When there's just half the properties that normally sell, then seller financing numbers are down like everything else. At the ratio of people seller financing versus conventional lending has drastically increased, and we see that increasing. This number is going to rock around. It may get to, Joe, we've seen it after the virus. It hung around 120.
Yep,
but
it did.
Feel way tougher underwriting than ever. So let's talk about the result of that. And that is when mortgage lending is cheap and easy, not meaning people seller finance. And when mortgage lending is expensive and scarce, then people go to the alternative that we tend to like, which is seller financing fills the gap. Yeah. Right. So that is the direction of our company and our business. And so we've been monitoring this, and I think that we are positioned for a good runway ahead for that reason. Joe, mortgage rates did not do what they thought on the 10-year bonds.
They did not, did they? They actually went up a little bit, Eddie, and that's what I was trying to say. Here on September 16th, T-bill rates were 3.63, and now they're 3.75 over here. So, yeah, they went up a little bit, and, that typical spread is still there.
The T-bond market rate, which is the 10-year T-bill rate, which is what really drives 30-year mortgage rates, they had already adjusted to the market. Yeah. That's what all the experts say, that they had already made the adjustment in anticipation that the Fed was going to cut rates. So then all of a sudden, when the Fed cut rates and everybody thought, well, mortgage rates are even going to get cheaper. And then they went the other way. And that's why.
Yeah. So we're just watching it and we'll see where it goes.
Our information technology today, Joe, is very interesting because a lot of times the market is anticipating the move that is going to happen. And when the move actually happens, you'll actually see no activity, or in this case, a little bit. There's some stuff happening with our boys over on the multifamily side. And Joe, we've been calling the ball on this for 2 years, and everybody said we're kooks and we're crazy. And well, now we're figuring out we maybe weren't.
Yeah, Mark Silverman, who is one of the smartest guys in the room on commercial mortgage-backed security and special servicing, is multifamily hit 5.71, and the new transfer servicing is up 16% from what it was. And here's the thing: the shocking data headline is early part of the year, it was about 2.6%, and now it's up over 11. And Mr. Silverman sees a 3-year cycle.
Look, we got lucky on this. My dad says the harder you work, the luckier you get. So I'll call it luck, right? We got lucky on this because really we just called the ball and we just said, multifamily the data is just not in its favor. And so we got a lot of friends in the business. We're not excited that they're in something that's not making money. but it is causing a dramatic trend in people coming to the note space with capital today because they're not investing in this product, right?
Yeah.
That's a market trend, and we're benefiting from it.
That's it.
So am I being opportunistic? Yes. Am I making fun of our friends in the multifamily business? No, they're not having their day right now, and we're having ours. We'll take it, right?
We'll take it. All right. So this is from the Fannie Mae mid-year multifamily market outlook, and it says skies remain cloudy, and this is the market asking rent change from 2019 to 2026. And Eddie, this is probably the downturn over here in Class C is really probably the reason that we're seeing Class A and B, ticking up maybe a bit.
Class A and Class B are gonna rent no matter what. They're gonna give away parking and cable and whatever it is.
Because concessions are high.
That ain't in the rent number.
No.
So I say that some of that number is bogus because they're giving giveaways so they can, quote, keep their rent up. Yeah. Office has done that for years, called free rent, right?
Yeah.
I had in 1984, Joe, I signed a lease on one of them glass office buildings in Dallas. On a 3-year lease, they gave me 18 months free rent. That's a true story.
18 months, yeah. And one of the things that I read yesterday, Eddie, is
the lease agreement,
yeah,
said that I was paying the full lease amount every month. So the document that said I got free rent was called a side letter.
Right.
Just saying.
And Eddie, one of the fears that some have is that as rates go down, mortgage rates goes down, people will then be bailing out of the rental market into buying a house, further causing some downward pressure on rents. So that's just one of the things that are out there. All right, let's look at the rental rate for new leases and renewals. And again, I think that this is probably due to the new leases are going up because some of the renewals, they're moving out and they're just swapping, right?
Well, yeah, but I mean, renewals still are outpacing new leases.
Yeah.
Right. And and that's because they can't afford to go somewhere else.
Yeah.
I think is a reflection of that. But anyway, it's we're watching the market, and the concluding factor is multifamily is not headed in a good trend, right?
Right.
And here's right there, Joe.
Yeah, from that multifamily market report from Fannie, there it is right there. Multifamily property values still declining. Yeah. And perhaps declining with 20 to 25% peak to trough. I like that.
Well, the guys that I know that I feel like are telling me the most truth about multifamily say we've already hit that number.
Yeah.
Like that's already happened. And they're worried about further declines. And so we're watching it, and it is definitely a variable. If you look at where it peaked in 21, really, the beginning of 22, and you look at that slide down, Joe, that's pretty traumatic. Pretty traumatic.
Yeah.
All right.
Let's talk about non-performing loans, Eddie. So
Fannie Mae or FHA still wins the prize.
It does. It's the winner, right?
The black line is the delinquency of FHA. And if you just look at it, it's on a different percentage level all the way across.
Yeah, that's right.
Right. And so those loans with FHA are more likely to be delinquent. That's just what the market always says. Fannie and Freddie new delinquency is not the problem. It's old, stale delinquency. And that's what you're going to see in these loan trades. It's not new delinquency is not a problem in the market. FHA, Gosh.
Mm-hmm.
I mean, it's, it's, well, they trend higher than I suspect we would want them to be, but there you go.
But that's what it is.
Yeah.
And we look at the numbers, you see that 2 million line. So here's where that, here's the total loans delinquent at 1,847,000,000. And Eddie, here's the, the updated days on.
These are loans that are in foreclosure, that 214,000 loan category.
Yep.
The loans that are 90 plus days delinquent, the average delinquency is 468 days, and loans that are in foreclosure are 1,198 days. Call it 1,200 days delinquent.
Right.
And so these are these seriously delinquent notes, and this is what we've been talking about as far as inventory to buy non-performing notes. So fresh loans and fresh delinquency are not the problem. It's the stale loans that really became delinquent as a result of the virus and they never have cured.
That's it.
That is where the inventory's at. And there's a good many of those loans.
There are.
Listen, we got 500,000 loans that are 90 plus days delinquent.
Yeah.
The odds of seeing those loans cure and not be a problem, it's not a high percentage chance.
That's right.
They're going to end up in some kind of a loss mitigation bucket.
Yeah. And Eddie, that just I added these just for the simple fact that they're coming out, and even on the institutional level, we've got, what did we say, 1,867,000 or something like that, but they're slow to come out, man.
I mean, Joe, this is a pool of only 1,800 loans.
There it is.
But
it's deeply delinquent, by the way. That's
yeah, deeply delinquent. We can bet on that. But it's only 1,800 loans, and it's still $300 million. So it's a huge number that's out there. Yeah. That's the Fannie bucket.
Right. Yep.
And Freddie's got the same thing. Another big trade of $233 million.
Yeah.
And these are all going to be super stale loans, and they're going to get traded to a big hedge fund. There's about 6 of them in the whole country that can bid on this thing. And then they're gonna have this distribution system where they'll sell those loans downstream to smaller operators like us. And so we'll end up with inventory out of this scenario. And Joe, this trend has not been very high up until the last couple of months.
That's right. That's right.
Last 60 or 90 days is when we're starting to see this. When we see this, it tells us some inventory is coming.
That's it. Starting to make those trades. So I'm going to draw. That's it, Eddie. We have, as far as the slides go, a lot going on in the marketplace as we're out there for the next few months. And Eddie, there is some congratulations in order on your part. Little Mr. John Wood Speed.
That is it.
New son of Hudson and Catherine Speed. Congratulations.
Yeah, we had a grandson born over in Louisiana on Saturday. And so we went over there to be part of that celebration, and we were blessed. He was healthy, and Mama's healthy, and they're home. Yeah. And so excited about that. And they're growing.
Yep, they're growing. Neat that he named him gave him his brother's middle name. Gave Woods his middle name. Yeah,
he did. Yeah. He did.
So Eddie, next week we're going to have our Note Expo show.
Yep.
And we're going to talk about that, and we'll pop a slide up here in just a minute, talking about how to register for that. But Eddie, it's coming.
Note Expo will be very exciting this year because the trend that we've been calling is now happening.
Yeah.
And so people are going to learn how to reposition themselves, or go there and network and make sure they have repositioned themselves. And I think the audience and the information, and I have been deeply involved in the curriculum of Note Expo and how that unfolds. I think it will be a rock star event. I'm really, really excited about it. I'm very fired up. Joe, we have 21 speakers.
Yeah.
And these aren't panels. These aren't a bunch of boring panels.
These are speakers.
These are speakers that have concise presentations that are very targeted to connect to what others people are saying.
That's it.
And so I'm pretty fired up about how we're doing that. We're going to tell a kind of an industry cycle story, but with all these speakers. And so we're going to talk more about it next week. Former NFL great Don Davis is our inspirational speaker. And if that don't light your fire, your wood's wet. I'm telling you.
That's right.
And so anyway, we're pretty amped up about it. And next week, I hope you can watch, and we're going to really just kind of go through and give you kind of a clarity about what Note Expo is about. Okay.
Eddie, we're coming up on the end of the month, and we got 3 more months left this year, and this is the tune-up that Note Expo is the tune-up that you'll need going into 2025. 2025.
Well, we've been calling for a market change. I think you can see this, and so I think there's going to be tremendous opportunity. Joe, when some things happen in the market, there's always an opportunity.
Absolutely.
There is always an opportunity if you're in the right spot. If you're positioned in the market. Being unaware is not a friendly place to be.
Not a smart place to be. And with that, well, we appreciate you being on this week. We're excited about bringing everything about Note Expo next week, and looking forward to a big fourth quarter. Eddie, we'll see them all next week. See you guys.
Bye-bye.
Bye now.